All right, well, let's kickstart the money show then and bring on board our very first guest. Tarun Birani of TBNG Capital joins us on the show. Tarun, hi, good evening. Thank you so much for taking out time. To start with, Tarun, we are at record high levels. For those individuals who are still on the sidelines, who have not yet, considered investing their money in equity markets, putting their money in equity markets, right now, as we are already perched at record high levels, what would be the ideal mutual fund strategy? How do you recommend investors invest in different categories?
Hi, Mobina. Thank you for having me here. So, the most important question, and I think if I have come here 10 times in last 10 years, every year this is a similar situation. Sometime markets are up, sometime markets are down. So as an investor, there is a constant dilemma, right? Nobody knows whether it's the right time to enter or exit. But my strong thesis of looking at investing is always driven out of suitability. What is suitable for you needs to be studied in detail. What is your risk tolerance level? What are your important financial goals? Those are the more critical issue one need to address as an investor. Once those are addressed and you know that money is available from a 5-year, 10-year perspective, I think one can look at riskier assets like equity in a much more meaningful way and not to be worried about the market situation from time to time. Now, let's talk about the current market valuation level. Current markets are at 29 PE level. We are at the famous Buffett market cap to GDP ratio is at 108, which used to be average of 69. So corporate profit to GDP ratio is from a historical level low. Industry credit growth is still low. From a business cycle perspective, we are in a sweet spot, which is like the early business cycle phase. So, which again gives me an indication that my markets are neither very, very aggressively valued or not cheaper anymore. So, as an investor, it is very important for one to look at a neutral path, and that neutral path according to me right now is to invest more into large cap oriented strategies, blue chip oriented strategies, look at global strategies, try to divide your money outside India also meaningfully, not to keep all your money in India. So that would be my broad way to look at investing in the current market. But my strong suggestion would be to follow the suitability and the risk tolerance level one has. Based on that, define what to do in the market. If you have already made profits, please book the profits. And if it is outside your asset allocation, rebalance your portfolio. It's a great opportunity available. And people who are starting fresh, they need to define based on your tolerance level.
Okay, so firstly, you should have a proper asset allocation plan. And if in case, it needs rebalancing, right now is a great time. If certain funds or if certain assets have gone up too much, then you can, perhaps redeem it a little bit, enjoy the profits as, we're at record high levels. So it makes sense to do that. But yeah, you mentioned that those who are still outside enter the markets as per your tolerance levels. So how do you decide that? And if you had to, let's say, advise a portfolio for someone with a medium tolerance, with a long-term wealth creation in mind right now, what sort of mutual fund mix would you recommend in equities?
So, Mobina, as you asked me the question, somebody in a medium risk tolerance level, I'm assuming a 50-50 risk tolerance level. Under that category, my suggestion would be the 50% equity allocation could be looked at with a larger bias into a large cap or a blue chip category. One can look at index funds for the same. One can look at global category. There are S&P 500, NASDAQ oriented funds available. One can look at investing in that category because I feel Indian markets have run up considerably. So it is important. One need to diversify their money outside India to avoid that home country bias in the portfolio, as well as mid and small cap looks a little overvalued to me right now, at least especially the small cap category. So one can wait for that at this point of time. And I think that tactical strategy, one can look at a thematic play like a technology sector, where I see visibility of growth for next 3-5 5 years is high, one can look at that strategy. And in the debt category, one can look at more focused under short-term arbitrage category, because I see a trend where the interest rates are going to go up in next 1 to 1.5 years. So it would be wise to keep low duration portfolio right now.
Let's talk about mid caps and small caps. We've seen so much volatility just in this last 5-6 days. We've seen a drop and then a recovery because there were certain circulars coming in from BSE. Now, I know what you said, that right now, mid and small caps look a little overvalued, so maybe not recommended for new investors. But for existing investors, what should be their strategy when it comes to mid and small cap funds, or rather, what should they be prepared for?
So, Mubina, we have to look at last 3-year history, how this category has behaved. 2018 and 19 had been a bad year for this category. We have seen SEBI recategorization happening. We have seen an ILNFS issue. So 18 and 19 has been a bad year for this category. 2020, we have seen an uptick happening in this category. And in last 6 months, we have seen this category has given phenomenal returns, and especially the small cap category has given phenomenal returns. I am of the view at this point of time, since this category has grown up so fast, it makes a lot of sense from a risk reward perspective to trim down some bit of small caps in the portfolio and rebalance your portfolio more towards large cap bias right now, because risk reward doesn't seem to be in favor for that. And again, this category requires one to look at on a regular basis. One cannot just invest and sleep in that. So tactically, small cap should be exited right now.
So if you've already reaped the benefit of the massive rally seen in mid and small caps, and again, if you look at it just in this last 1 year, yes, there's been a rally, but for extremely long-term small cap and mid cap investors, frankly, prior to 2020, 2018-19 had seen quite a fall in mid caps and small caps. But right now, at these levels, according to Tarun, they are looking a little overvalued. If you have made a profit, though, he recommends that maybe you should consider now slowly redeeming some of those mutual funds. Flexi cap funds, Tarun, a very interesting category, very exciting one, seen most flows, but that's also because a lot of mutual fund houses are now launching funds in that particular category. How should investors look at this category when deciding on their asset allocation? Because this is not something that you can say that, okay, it's less risky or more risky. It's sort of a free flow. Fund manager can put as many large cap stocks, as many mid cap stocks, as many small cap stocks. So does this, if you say that, okay, I want to put, I want to add a flexi cap fund in my portfolio, does selection of fund become extremely important for this category?
Right. So, Mubina, I am a big votary or in favor of having a very simple portfolio. I think we should try to uncomplicate our life rather than complicating it with so many categories in the portfolio. If you look at either a large cap, mid cap, multi cap, flexi cap, all these categories, end of the day, have a mix of either a large or a mid cap portfolio. If we can bundle a portfolio with a pure large and mid cap in a proper way, I don't think one needs a flexi cap or a multi cap kind of portfolio. Talking about flexi cap, meaningfully, if you look at flexi cap is required in the portfolio after the erstwhile multi-cap category has SEBI diktat has come from that, and most of the funds have converted themselves into flexi cap category. And flexi cap category gives them flexibility to have large and mid and small cap allocation also available in this portfolio. So I don't find this category as that exciting, because now from a simplicity sake, if you have a good large cap fund, good global fund in the portfolio, or a good small or mid cap in the portfolio, you genuinely don't need a flexi cap. But there are some outlier or good funds available which one can look at, which are giving very differentiating experience to the client. Those products could be looked at in the market.
Okay. Understood. So a simple portfolio, an uncomplicated portfolio, that's what Tarun favors, and flexi cap funds can add that tinge of complication. There's one category though that has not been finding itself in the favor of investors for the last couple of months. The last 2 months we've been seeing net outflows, and that is value funds. They seem to be shunning them of sorts. Tarun, value funds have really got the shorter end of the stick. We've not seen, them doing much. NAVs as well have largely stagnated. Yes, we did see a little bit of traction come by earlier this year, but it's more or less died down. What's your view on this category? What would you recommend those individuals who are holding units in value funds do?
Again, as I told in my last question also, I am not in a big favor of having all these fancy categories in your portfolio. One can have a very simple and uncomplicated portfolio. Leave it to the fund manager whether he wants to take a growth strategy or a value strategy. So most of the diversified fund in the market fund manager has the ability to either pick a value stock or a growth stock in the portfolio. So from that point of view, there is absolutely no need to have any different value or a contra fund in your portfolio. So, and people who are currently owning these value or contra funds, they may have to look at their existing portfolios and accordingly decide. But I feel it is just not adding too much value to have a separate category in the portfolio. A well diversified fund is taking care of that already.
One large cap fund has 70 to 80 stocks. A mid-cap fund as well has 70 to 80 stocks. There are all kinds of stocks really. Some of them do have a certain style as well in them. For example, the fund manager could put some stocks which are a little more expensive, some which are, which he finds value in. So there's always a different mix of stocks. So you really don't need to add many categories and, overcomplicate the fund, or perhaps over diversify it as well, because that's what you could end up doing. So far we've spoken about equity funds. What's about debt funds? Last year we saw, for example, a long duration fund deliver double-digit returns. But this year I think investors are now redeeming their money from those funds.
So Rumina, my sense is the party is over in the this category as we talk right now, because we are in the fag end of the interest rate cycle, wherein we expect that what we have seen in last 1-2 years, the interest rates coming down. Going forward, we expect the interest rates to go up, and inflation is going to go up in future. So from that point of view, one need to avoid longer duration funds in the portfolio. My strong suggestion would be to look at short term or a arbitrage oriented category at this point of time. And once you see a reversal in interest rates or the interest rates going up, maybe after that actively this longer duration and other medium duration funds could be looked at in the portfolio.
All right, understood. Well, you know what? That was a comprehensive take of how to look at different mutual fund categories. The mantra really for Tarun is simple. Don't add too much. To keep the mix simple. And that will just make it easier for you as well as an investor to keep track of what you have, what you don't have, as opposed to just mixing in all these different kinds of funds and different kinds of categories that have been created. Okay, let's take on board some questions and queries, and let me tell our viewers that you can connect with us. Our email address is themoneyshow@etnow.tv. So let's take on board some questions. Our first question is from Sanjeev. He says, I started 2 mutual funds recently, 8 lakh rupees. Now I'm not sure if it's 8 lakhs in both or in each, but there's a technology fund and a NASDAQ fund. He says, I want to allocate 15 lakhs between them. What should be the split? And should I do an SIP for 3 to 6 months or a lump sum? He says my total mutual fund portfolio is 60 lakhs. Okay, so I think he's yet not invested, but he wants to invest and he has his eye on these 2 funds, technology fund and NASDAQ fund. Firstly, Tarun, what's your opinion on thematic based funds or theme funds? In retrospect, these funds look great because they've given very good returns for investors. So still, it's all about hindsight, right? And secondly, SIP or lump sum?
Sure. So from a theme based, I am always a very strong believer of a core and satellite level of portfolio. So the core level can always be a very sturdy, long term buy and hold kind of portfolio. And the satellite portfolio could be something which could be more tactical. One can look at current market situation and play it in the portfolio accordingly. So thematic category is one such category which which could be considered in under thematic category like healthcare, technology, banking, all these different categories. If one is extremely bullish on this kind of category, or you have seen a significant correction happening in this category, one can look at from a risk reward perspective these category in their portfolio. We have seen categories like healthcare and technology has given very good long-term durable returns. Again, we have consumer cycle categories available which have again given good returns. So from a long-term return point of view, I see a lot of merit in looking at these categories, but it should be looked at from the satellite portion of the portfolio. Now, talking about this specific query which you have asked about that NASDAQ fund and the technology fund, I am again a very great believer into investing outside India. The global category is a must in the client's portfolio. The big reason for that is you don't have all the best companies available in India. Rupee is depreciating from almost 4% every year from last 2 decades, and again you are seeing a lot of correlation is very high. If let's say any large cap fund or a mid cap fund or multi cap fund, if the Indian economy goes down, everybody will be impacted. So from that point of view, I feel one should diversify meaningfully outside India. There are a lot of exciting categories available, and in India there are a lot of global funds available, so one can look at that in the portfolio. In this specific case, I can see almost 25 to 30% of the investment has been going into a technology oriented theme, which according to me is a very high risk strategy. One should try to trim it down. Again, a 3-month SIP would be a great way to look at investing, and my tilt would be more towards global or a NASDAQ or a S&P 500 category.
All right, well, let's take on board our next question. It's coming in from Manish Tarkari. He says, my current age is 28 years. I want to make a corpus of 1 crore rupees in 10 years. Please suggest in which fund should I invest and how much do I need to invest on a monthly basis? Where do you recommend he start off? He's very clear with his target 1 crore rupees in 10 years. He's not mentioned if he has any limits in terms of how much we can invest. So based on the expected rate of return, the power of compounding, how do you recommend Manish start off?
So, Dubena, according to me, one need to have very reasonable expectation when one starts in looking at investment. So, from a goal perspective, a 1 CR in 10 years, looking at a 10 to 12% of average growth rate, one need to invest almost 45 to 50,000 per month. Okay, so according to me, this looks as a very, very practical plan over a 10-year period. One need to have a core and satellite approach in the portfolio, wherein the core portfolio could be sturdy, buy and hold, and satellite portion could be something which can benefit from the current tactical opportunities available in the market. Again, mid and small cap could be one way to create longer term alpha for the portfolio. But again, since it looks overvalued in the current markets, maybe one can look at the time when you find it more favorable.
All right, let's take on board our next question. Ajaz T writes, looking at the current interest rate, is it advisable to invest in the Axis Banking and PSU debt fund? What would you recommend, Tarun?
So currently, if you look at the YTMs of this category is going through a very low phase. The YTMs are between 4 to 5%. Add to the debt taxation, again, it becomes, if you add holding is more than 3 years, you get the indexation benefit. So from a risk reward perspective, I don't see this category giving good returns at this point of time. So one can avoid this and maybe one can look at arbitrage category to invest the money. And once you see a rise in interest rate, at that point of time, one can look at parking long-term debt investments.
All right. Well, I think that's all the time we have for questions and queries. So, Tarun, we let you go on that note. Thanks so much for joining us this evening on The Money Show.
Thank you so much. Thank you.
And on that note, we're going to take a short break, but be right back with lots more on this episode of the show.